How to Avoid Loss and Earn Consistently in Stock Market by Presenjit Paul. Chapter 1. Basically, F&O is meant for institutional investors and hedge fund. Big companies or high net worth individuals hedge their positions using F&O. Future trading is a great option for hedging. Intraday, short-term trading and F&O, all those are nothing but another form of gambling. Brokers, stock exchange and government, only they can earn consistently from trading. Short sell refers to selling first and then buying at a lower rate to gain on the same day. Chapter 2. Before purchasing cars, expensive mobiles or television, we undergo rigorous research. While purchasing a stock, do you conduct such rigorous research? Chapter 3. First step of picking winning stocks. Big profit doesn't ensure real cash flow. Profitable growth might be fueled by external debt. In short, profit growth doesn't ensure the quality of any business. More or less, many large enterprises alter profit numbers as they know amateur investors will first focus on profit growth. We should put the least priority on profit and sales growth numbers and more on return on equity, ROE. Return on equity. Increasing ROE over the last 5 to 10 years with improved operating margin and cash flow is a signal of sustaining economic moat. Debt. A clear understanding of debt to equity ratio will serve your purpose. Debt to equity ratio equals total liabilities, equity. Before investing in any stock, have a look at its debt to equity ratio. Check the ratio for at least 3 years. Greater than 1, and increasing continuously, carries red signal. Not relevant to banking and NBFC companies. If you find the stock having ROE of less than 12%, and decreasing, and a debt-to-equity ratio of more than 1, and increasing, then discard it. In 90% of cases, debt-to-equity ratio is sufficient enough to analyze the debt burden of any company. Higher the ROE, better the investment option. Chapter 4. How to Evaluate Management. Promoters or institutional investors purchase stocks via block deal or bulk deal from the open market. Companies or individuals other than the promoters holding more than 1% of the total share capital need to disclose their details. Promoters increasing stake via open market purchase is a positive signal. If the promoters raise their stake, it is comprehended that they have high confidence in the business. Initial entry of big institutional investor is the first sign of good times. Greater than. Don't take the decision based on the numbers. Dig deeper for the real picture behind numbers. FII, foreign institutional investors, smart people investing their smart money. Higher FII's stake is interpreted as positive, and a lower FII stake means low confidence of FIIs in the company. If FIIs sell their shares, then it doesn't mean that the company is fundamentally weak. DII, increased investment from DII is positive for any stock. You need to be careful if you find a stock where individual shareholding is increasing while promoters' institutional shareholding is decreasing. Institutional investors are the most knowledgeable, after promoters. Pledging of shares. Pledging of shares is the last option available for promoters to raise fund. It means that no one else is ready to provide loan because either the company is in bad business whose future prospect is not bright, or the company has high debt and might be under financial constraints, hence pledging remains the only option left. If any company is already laden with debt, then they don't get a further loan without collateral. If any company has a pledging percentage up to 2 to 8%, then it can be ignored. Always avoid companies where promoters are increasing their pledged shares. Avoid companies where promoters pledge more than 30% of the holdings and the pledged percentage is increasing. Dividend history. Companies those are consistently paying dividends over the last 10 to 20 years must have a solid business. ROE. High and consistent ROE is an indication that the management is utilizing the capital effectively. Chapter 5. Valuation. It matters much if you purchase a quality product at an excessively high rate. Do you find another buyer to take it even at a higher rate? No. Identifying great business is the first step of successful investing. Common valuation tools. Price to earnings ratio, PE ratio. PE ratio equals current market rate, earnings per share, EPS. Best usage of PE ratio. Compare with its historical average. If you find that a fundamentally strong stock is trading much below its historical average, then it might be a worthy investment. Compare with its industry peers. Normally, a stock that trades at a PE below than their industry peers is valuation-wise more attractive. However, don't rely much on this parameter. Exception. A large cap pharma stock that is trading at 30 prices to earnings ratio may not be expensive, whereas a small cap pharma stock quoting at 20 PE might be considered as expensive. High growth companies always demand a higher PE. Higher capital requirements translate low valuation. Drawbacks of PE ratio. Problem is that a company can easily distort their reported profit. One-time income can easily inflate profit, and this lowers the PE ratio. Similarly, the one-time expense can negatively affect the reported profit, and this translates into higher PE. Cyclical firms are those companies whose profit increases heavily during a particular period, then decreases after some time. Companies having fluctuating earnings are known as cyclical firms. Your purchase decision should not be based only on PE ratio. 2. Price to sales ratio, PS ratio. PS ratio equals current price of stock, sales per share. Advantages. Total revenue, sales, is not frequently manipulated. Unlike PE ratio, the PS ratio is not manipulated too often. Disadvantages. A company might report loss with increasing sales. So while judging PS ratio, check the industry in which the company is operating. 3. Price to book ratio, PB ratio. Book value per share indicates the amount that each shareholder should receive if the company liquidates completely. Best usage. Banking and NBFC stocks, capital-intensive businesses. Drawbacks. PB ratio has almost no significance for software companies. Combining PB ratio with ROE, the one with higher ROE will have higher PB ratio. Companies whose ROE and PB ratio don't go hand in hand should be analyzed with extra care. Lower the ratio, better the investment opportunity. Doesn't have significance in the service sector or software firms. If a business can grow 30% annually, then it should command the premium. The easiest way to judge valuation, compare with its historical average, and the second one is to compare PE with average growth rate. It doesn't require in-depth understanding or complex formula to earn big in the stock market. Comparing PE with average growth rate, it is the EPS that matters the most. PEG ratio equals PE ratio, earnings growth rate, EPS. PEG ratio, less than 0.5, equals undervalued, great investment bet. PEG ratio, 0.5 minus 1.0, equals either undervalued or reasonably valued. Good investment bet. PEG ratio, 1 to 2, equals reasonably valued. Check other parameters before investing. PEG ratio, greater than 2, overvalued. Avoid. PEG ratio combined with historical data will provide better insight on the valuation. First of all, find out the average PE ratio for the past 5 years. Average PE, 8 to 12, 20 to 40% discount than average, which is less than the last 3 years' average growth rate. The range of 8 to 12 is considered undervalued. Attractive entry opportunity. Average PE, 12 to 18, near average, stock is reasonably valued. Good entry opportunity. Average PE, 20-30 plus, overvalued. If at the same time, PE ratio is greater than twice of the last 3 years' average profit growth rate, then avoid the stock. Average PE, 5 to 8, or below 5. Attention. Summary of the above example. Undervalued companies' current PE and PB ratio less than last 5 years' average. And current PE is less than PEG, less than 0.5, 2 reasonably valued. Current PE and PB ratio tilde last 5 years' average, and current PE is less than equals PEG, less than equals 1, overvalued companies. The current PE is double of PEG, PEG greater than 2. And current PE and PB are highest among last 5 years' average. Chapter 6: When to buy and when to sell if fundamental remains intact and improving. One should not hesitate to add more even after 100% or 200% price appreciation. If you can figure out an extraordinary business with great future potential, then it is never too late to buy. Timing should never be the cause of concern for high-quality stocks. Even during the market correction, great or high-quality stocks don't fall much. Stocks, mainly mid-caps and small caps, hitting fresh lifetime high during choppy or bear market require special attention. Those can become a great investment bet. Selling is difficult than purchasing a stock. Selling decision should be based on predefined criteria, not on the stock price movement.
Don't hesitate in shifting to the better opportunities even if the stock has given a multifold return in the past.
You should exit at the first sign of trouble. After investing in any stocks, later if you realize that the initial buying decision was faulty, then you should exit from the stock at the earliest. One should exit from the stock if the valuation becomes too expensive. A stock with PE of 40 may not be expensive, while a stock with PE of 10 can be overvalued. Stay away from stocks those are recommended by everyone, and the stock price is moving at an abnormal rate. If you purchase a high-growth stock and later the growth outlook changes or some external factor makes it difficult to grow, then you should sell immediately. Exit from a stock when your original purchase reason is no longer valid. Purchasing a high-growth stock and continue holding it because cheap valuation is one of the biggest mistakes that investors commit. Investors should immediately exit once a high-growth stock loses steam of growth due to fundamental changes. Holding such stocks can only maximize loss. Investors should consider a change in the leadership position as one of the important events and should make decisions based on it. Poor management can turn a great business into an ordinary one. Develop a predefined exit strategy while investing in stocks. If the reason of purchase is clear, then you won't find any difficulty in exiting. Deadly mistakes to be avoided: investing in previous bull market stocks.
It's hard to repeat the same trend. Holding loses too long.
Maximum retail investors either hold the stock hoping for recovery or they add more to average out their buying price. Both are deadly mistakes. On the contrary note, an investor should not sell a stock just because the stock price declined by 10 to 30%. If fundamentals remain intact, then there is nothing to worry.
Irrespective of your notional loss, you should sell losers and fill the gap with winners.
Investors prefer to hold losers for a long while booking early profit from winners. Even after knowing something is wrong, some investors wait for a bounce back. Losing money is painful, but widening the loss is disastrous.
Pay maximum attention to losers. Price correction due to fundamental deterioration is permanent in nature.
Don't invest like a trader and don't trade like an investor. Chapter 7: Do's and Don'ts to Avoid Loss in the Stock Market. Over the short run, the quality stock can move either in the upward or downward direction, but over the long term, it can move only in upward direction. You need to act like a business owner. Keep a close watch on the business industry related news, quarterly result, and management interviews. If you can't hold a stock for 10 years, then don't buy the stock for the next 10 minutes. Don't take your investment decision based on short zero-term price movement. Never ever calculate profit, loss until you are selling stock. Perhaps, the stock market is the only place in the world where buyers shop less during the discount session and prefer buying more at higher rates. As an investor, your only task is to select great companies and invest at the right time. Following the prediction of the overall market movement is a wastage of time. Have a closer look at the business model, the financial numbers, and the future outlook of the company.
Investment opportunity in the prolonged bear market doesn't come frequently. Once or twice in 10 years, such golden opportunities arrive. Most of the companies during those periods are available at throwaway valuations.
A market correction of more than 50% compared to recent peak brings such golden opportunities.
Chapter 8: How to construct your portfolio. Portfolio construction may seem like an easy task, but the truth is that proper portfolio allocation is one of the most complex parts of successful investing.
While diversification can help you in creating wealth systematically, over-diversification can erode your hard-earned money. The properly diversified portfolio must have a limited number of stocks but diversified across sectors. You should follow, at least, quarterly results, all business-related news, and competitors' status with management interview or interaction with any business analysts, and this will require at least 30 minutes per week in a single stock. Always remember, the number of high-quality stocks is always much lesser than the poor, or average, quality stocks. Misconceptions: large cap stocks always offer safety and a steady flow of return. Fact. Banking sector responds first during any economic turnaround. Fact. Small cap investing is much more rewarding than large cap. Stocks that have already doubled in recent past have less potential to move up further. Fact. If a company can perform well during adverse macroeconomic condition, then it is expected to perform even better once the external business environment turns favorable. Stocks that fall sharply must have to move up sharply. Fact. Sharp fall in stock price is the first sign of trouble. Fact. Price correction of more than 60% indicated red signal. History says you can't suffer loss if you invest in any stock market crash or any point of time while 90% of analysts are in bearish view. During a major stock market crash, index is down by 50% plus. It doesn't matter how well experienced or well qualified you are, it is almost impossible to manage 20 to 30% return. Gold and equity mostly move in the opposite direction. You need to sell off your entire portfolio much before such major stock market crash and sit in cash. During the major stock market crash, investors need to maintain huge cash in hand for 6 to 10 months or more. Stay away from high debt companies at any costs. Increasing debt to equity ratio is an alarming situation. Even during favorable market situations, high debt companies fail to perform. Try to avoid companies where the promoter themselves are not holding a majority stake. As a rule of thumb, avoid companies having a market capitalization of fewer than 300 crores with promoters holding stake less than 20%. It's a serious matter of concern if the combined shareholdings of promoters and institutional investors remain less than 20%. Being a small company, you won't find a proper research report or reliable information in the public domain. High promoter pledging, and increasing, it means that no one else is ready to provide load because either the company is in a bad business whose future prospect is not bright, or the company has high debt and might be under financial constraint. During a bull market, pledging is not a problem because promoters can rely on the optimistic value of their stake. Always avoid companies where promoters are increasing their share pledging. It's better to avoid such stocks completely. Stocks touching new low. More than 50% decline from the recent peak of any stock indicates a red signal.
Many times costly acquisitions with huge external debt and inability to turn around the acquired company causes wealth destruction.
Be aware of stocks which are going for costly acquisitions and opting for huge external debt. Chapter 9. Is it required to follow an equity advisor? A mutual fund is not advisable for you, as direct equity investment with proper guidance will fetch better return across any market situation. Cross-check the basics like ROE, debt level, growth numbers, shareholding pattern, etc. With proper guidance, direct equity is far more beneficial and rewarding than a mutual fund. If you are unable to figure out reliable equity advisory, then stay away with mutual funds. As an individual investor, I can invest in any micro-cap or small-cap stocks, but mutual funds can't. If you want to earn a great return, then you need to buy when everyone is selling and sell when everyone else is buying. Moreover, mutual funds can't invest in quality micro-caps and small-cap stocks where the upside potential is huge. Avoid entities that are promising extraordinary return and asking for huge fees. Avoid entities that are not offering any logic behind stock recommendations. Be aware of statements like 99% accurate jackpot calls, or like 100% accuracy level. Be aware of entities that are calling on a regular interval to sell stock tips. Chapter 10. Quick formula for picking winning stocks. First step. Make sure to find out stocks those are matching all the following criteria. Last 3 years average return on equity, ROE, and return on capital employed, ROCE, both are greater than 20%. Debt to equity ratio is less than 1, or heavily reducing for the last few years. Promoters pledge less than 10% of their total shareholdings, or there is a clear indication that it will fall below 10% soon. Better if it is nil. Last 3 years CAGR sales growth rate is more than 10%. Last 3 years CAGR profit growth rate is more than 12%. Second step. Valuation. Same as discussed earlier, ch. 5. Stock price movement. In spite of having all the positive numbers, if you find that the stock is generating a negative return over the last 3 years, then avoid it. If last 3 years annualized return is less than 10% and last 1 year's return is negative, then mark as avoid. If last 3 years annualized return and last 1 year's return both are negative, then avoid. Only consider stocks for investment having last 3 years annualized return is more than 10% with last 1 year's return is positive. In the long run, or over a period of 3 years, the market can't misjudge any particular stock. Over the long run, the stock price is nothing but the reflection of the underlying business. This is why you find a company that is growing at more than 20% over the last few years with zero debt and ROE of 25% but trading at 50% discount compared to its peers. Then you need to dig deeper.
Don't consider price movement for the short term.
Important points to remember. The above formula is not applicable for banking NBFC stocks because parameter like debt to equity ratio is irrelevant for them. For analyzing banking and NBFC stocks, parameters like NPA, NIM, etc. will come into consideration. During bear market, more companies, stocks, will pass the test. However, during a bull market, only a few companies will pass the test. The quick formula will work for most of the time. However, it doesn't mean that those stocks which are not passing the test will generate a negative return. 2 minutes checkup to judge any company: average last 3 years ROE is less than 10%. Debt to equity ratio is more than 1 for the last 3 years and no sign of falling down. Promoters pledge more than 30% of their total shareholdings and no sign of falling it down, rather increasing. Based on the above 3 parameters, your decision will be as follows. If all those 3 parameters hold true for a particular company, then avoid the stock at any cost. If you already hold any such stocks, then exit from it immediately. If any 2 of those parameters hold true, then avoid that stock. If any one of those 3 parameters holds true, then the stock requires in-depth attention. If you want to take a conservative approach, then avoid the stock as there are 5,000 plus stocks in the market. Note: it is not valid for banking and NBFC stocks. Comment: this is the original summary I wrote a few months ago. I feel that this book by Presenjit Paul is one of the best books ever written on investing. It's so precise, a lot of good examples are provided, and easy to understand.